Today I'd like to break down a back ratio options trade for you, which is very useful to put on during earnings. And the example we're going to use is the one that traded last night and reported earnings this morning, June the 3rd, Dollar General. Now yesterday Dollar General closed right here at about 54.30. So sometime in the afternoon, the following trade was put on. And for that, we're going to use thinkorswim's Analyze and Risk Profile tab. So this trade was put on right here. I personally put on to buy the June weekly 56 call and sell an equal amount of the 56.5 and the 57. Now this is a trade, this is a back ratio trade, and for purposes I'll call it a back ratio flat trade because it has a flat top where it's going to produce the maximum profit at expiration. If we had taken a standard back ratio, it would have been the 56 and 2 of the 56.5. So buying, for in this example, 10 of the 56 and selling 20 of the 56.5, and now you'll have what looks like a back ratio sharp, where your maximum return at expiration is going to be a single value. What you notice about this trade is that there is no downside. Because you're collecting premium, and in the case of my trade yesterday it was 30 cents, because you're collecting a premium, you get to keep that premium as long as the price stays below your losing value point, which is right here. In the case of my trade, it came out to 57.29. Maximum profit would have been achieved on a standard double ratio at 56.45. Now, because I took the 56, 56.5, and 57, the flat back ratio, maximum profit is achieved between 56.45 and $57. So it gives me more of a sweet spot area. And like the back ratio sharp, has no opportunity to lose money if Dollar General should fail after earnings. But what Dollar General did was pop. So now let's look today, Tuesday, January the 3rd, at 2:45 in the afternoon. And the stock is actually trading right now at 56.47. So it's trading towards my sweet spot. Today is Tuesday, and to maximize this trade, I'm going to have to wait till Friday till all the time value in my short calls decays. My long call is in the money. I bought it at the 56 strike price. I'm now at 56.48. But I'm not going to get out of the long call because that would expose me to having 20 short calls. And I don't know what's going to happen between now and Friday. So I'm going to monitor this. This is June the 3rd. So I'm going to forward this now to June the 4th. And you can see how the time decay goes in my favor. And if the price doesn't change, tomorrow at this time, this will be worth $230.34. On Thursday, at this price, it's going to be worth $331.80. And on Friday, it's going to be worth $467. And if I wait till expiration and it stays here, then my 56.5 is going to expire worthless. My 57 is going to expire worthless. There will be some profit in my 56, and I'll walk away with $768. Now, if the stock should retreat in the next few days, the worst I can do is $300. There's a margin requirement for this, and you'll have to check with your broker for this margin requirement. And if you put on a trade of 20, 20, 20, your margin requirement will grow substantially, but now your profit opportunity doubles, where you can't do worse than $600 as long as you stay below the 57.81. But at your sweet spot, this innocuous trade of a 30-cent credit is worth $1,600 to you. Now, the opportunistic trader will put one of these on with puts as well. And what you'll end up with on the left-hand side is the mirror image of either a sharp or a flat ratio, giving you an opportunity for increased premium as long as you stay between the 2 points of your risk profile. Each end of the profile will have a sweet spot, and each end of the profile will have an area that drops off where you lose. However, this is how you handle a loss. And for that, I'm just going to delete the combined trade and show you how the trade was made up. A ratio trade is nothing more than a bull call spread that yesterday cost me 16-cent debit. But when I sold an equal amount of the 56.5 calls, I collected 46 cents credit, and my net credit was 30 cents. Do you remember the 30 cents? Now, if instead of doing this, I had done, let's move to a custom, and let's change this to 20. If I had done the sharp back ratio, I wouldn't have collected 30 cents. I probably would have collected about 20 or 18. So this isn't a fair representation. But the back ratio would have consisted of, the sharp would have consisted of 10 long, 10 short 56.5, and another 10 short 56.5, so 20. So when you want to get out of this trade, because your trade has gone beyond this point and you're losing money, what you do is on Friday, expiration day, you close the bull call spread for a profit of $340. In my example where I bought 10 and sold 10. Now these other 10 above my, let me go back and show you where the break-even point was. Remember, the break-even point was 50, in this, right now it's 57.29 in this example. Take that off. This trade will have a loss of $326. And of course, if the price goes further higher by Friday, then your loss increases. So what you do is you close your bull call spread for a profit, and you roll the loser. So what I would want to do is I would create an order to actually roll that into a future week and collect more premium and look for a pullback. So that's how I would handle a loser. And the best thing you can do, of course, is to have a winner and close it at Friday for a substantial profit. Now, if you have any questions about the ratio trade, or you want to get in on some ratio trades with other traders, follow Anne-Marie at the Trading Book. Go to her website, look at the About, Get in Touch tab, and fill out the form, or get a hold of her on Twitter at Anne-Marie Trades and ask her how you can subscribe to some of these trades with the rest of us.